Hey everyone, Ian King here, editor at Smart Profits Daily with your weekly market insights video. And I'm joined again by my colleague and editor of Total Wealth Insider, Jeff Yastine. Jeff, how's it going this week?
Hey, it's going great. Market's off to a good start so far, and welcome back, Ian. Been missing you on this talk that we have every week with Market Insight. So welcome back.
Yeah, well, it's good to be back, and I want to just give a quick thanks to Brian Christopher for filling in the last couple of weeks. I've been following the videos, and you guys did a great job without me. But before we get into this week's content, I first want to say, if you haven't subscribed to our channel, please hit the subscribe button. If you like what we have to say, always give us a like. It helps other people find our content on YouTube. And also, if you subscribe, you hit that little alarm button, you'll get the new videos as soon as they come out. But Jeff, we got a lot to cover this week. And what a year it's been. I remember a couple months ago when you and I were talking about January and everything seemed so boring. And we said maybe the market's going to have a 3% pullback at some time. Well, a lot has happened since then. And the market's dropped 35%. We rallied back about 26%. The S&P is now only 15% off its highs. What do we make of the bull case here, Jeff? What are you telling your subscribers right now?
Yeah, for the bull case, there's a couple of really powerful trends in effect here. Number one, if you look at the headlines, there is a record amount of short selling going on, and I believe it's from retail investors who, having experienced that 35% drop that we saw in the S&P 500 and in February, March, are like, hey, this is the most obvious thing. The market's got to go down here, and that this thing is just a bounce. So they're all piling in on that side. So then when you short sell, of course, if you're wrong, eventually you're forced to then cover your bets and buy back the stock you borrowed, and that forces the, those shares even higher. And so you can consider how many people are shorting the SPY right now and the other associated indexes. You can see where that's rocket fuel as they keep making these wrong bets to push the market higher. On the other side of all this, you have the sort of tentative reopening or planned reopening, whatever you want to call it, of the economy and associated industries. And you have the companies that are planning for all this, and some generally decent news regarding perhaps getting a handle on the virus, which may or may not prove true in the long run. But all this is feeding into this general optimism. I see us heading higher here through at least the end of May. Beyond that, we'll have to see. A lot depends on how quickly the economy turns around. As for right now, investors obviously think the market's going to come back, the economies are going to come back very quickly. Whether that happens or not is really, I think, the debate coming up for the summer, maybe a little further down the road.
Yeah, I mean, definitely there's a lot of unknowns. And I mean, do you think that people are being too optimistic about reopening so soon? I mean, we're still seeing some cases of COVID-19 spreading in these states like Georgia that are trying to open up barbershops and massage parlors.
Yeah, I would say yes. I think you have to be cautious about that. Obviously, there's a good chunk of the market, retail investors and others in the institutional side of things, who think that, hey, the bottom's in, you got to buy this. What I'm telling my subscribers is enjoy this rally. Doesn't mean you can't put new money to work, but make sure you're buying it at a good value. Don't start chasing stuff that in a month from now may be at new all-time highs and also even more overvalued perhaps than it was back in February and January, when you and I were wishing for that 3% pullback.
Yeah, be careful what you wish for, right? I mean, it really is one of the most perplexing thing about markets is that there are more sellers down at the lows of the S&P, and there are more buyers now that we've rallied 25, 26% from the lows. I mean, it really is what makes investing so difficult. But, we've got a big week this week with a ton of companies reporting earnings, or maybe not reporting earnings, because we'll see what they have to say. And just a quick list I went over. We've got 3M, AMD, Alphabet, Ford, Pfizer, Starbucks, Boeing, Facebook, GE, Microsoft, Tesla, and that wasn't enough. We've also got later in the week Amazon, Apple, and Twitter. Now, remember there was this op-ed 2 years ago that was co-written by Jamie Dimon and Warren Buffett in the Wall Street Journal. And they argued that we shouldn't be focusing on these quarterly earning reports because it makes investors too short-termism. And it's kind of ironic now because all these companies are coming out this week and there's going to be no transparency. So are we at the point right now where maybe this kind of short-termism has been taken away because of the coronavirus, and these companies are going to say, look, we're not going to forecast how our earnings are going to be in the second and third quarter, but things are going to get better when they get better. I mean, do you see maybe that sentiment finally is going to change about investors caring about what's next?
No, I'll put it back on you in a moment and ask you the same question, but my view is no. Unless the government, unless the SEC came out and said, from now on, companies only report every 6 months, I think there's still always going to be a focus on quarterly numbers. And frankly, and we see that with hedge funds and others using alternative data sets to figure out month to month and week to week how companies are doing, simply because we live in that sort of environment where we want as much data as possible. It can be a danger, to have too much data because you end up, short-circuiting yourself. But I think it's just in the environment we're in, there's just no way you can push back the clock. That's like thinking in the 1980s and 1970s where when you wanted data, you went to the library and looked at Value Line or something like that if you're a retail investor, before the internet. So yeah. I don't know, what do you think as far as, again, that quarterly short-termism element that Buffett's campaigned against, as you said, but I don't see it going away anytime soon. I don't know what you think.
I don't think so. I think that all these companies coming out this week are going to say, we don't know, we can't forecast how next quarter is going to be. We can tell you how we did so far this year, but we don't know because most of our locations, if you're on the retail side, if you're not Amazon, they're closed. So how can you expect or have any predictions on how your products are going to sell? I mean, Ford, who is buying cars right now? I don't even know any auto dealers are even open. I could see Pfizer having transparency, but they might also have supply chain issues with the pharmaceuticals they manufacture over in China. But
let me flip it around for a second, though, just because it kind of goes to the whole thing of expectations. What do you think is the possibility here, though, that as so many of these companies have basically withdrawn their earnings weeks ago and said, we don't know what's going to happen. We're just not going to have any guidance or forecasts at all for Wall Street to use. So, the market just sells off in panic because they have zero data. What do you think will happen as these companies come out with earnings? And there may not be much transparency, as you said, but just the idea that the earnings aren't as quite as terrible as Wall Street perhaps first assumed back in March, that could then continue to propel the market higher simply because everybody assumed the worst. What do you think about that?
I mean, a lot of the news you'd have to imagine is priced in. We did have a 35% correction and the market's forward looking. I think the bigger focus, though, is really on how much stimulus is going into the market right now. So if you look at the Fed's balance sheet has expanded up to $6.5 trillion. They pretty much ring-fence every single credit market imaginable. And now you see that they're buying corporate bond ETFs. So they're in that market for the first time. They're going to keep rates at zero basically forever. And what we didn't have in 2008, we have now is a huge government stimulus package. And I wouldn't minimize this. The government, first in the CARES Act, passed $2 trillion worth of stimulus, which some went to small businesses, some went to large businesses, other went to $1,200 stimulus checks. They added up another about $400 billion, I think, last week for small businesses because that program ran out quickly. And so, for the shortfall that's happening in the economy, it seems though the government is actually making up more of it. And I want to just pull up this chart for our viewers right now. In some states, the unemployment benefits are actually higher than what the average wage is. And that's about half the states in the country. So some people in these states are doing better off by staying at home and collecting unemployment than they were when they were working. And you have to think that this, in the longer term, is going to have a stimulative effect. Now, look, the government is going to run huge deficits, and people are going to be worried about how much debt the U.S. economy, what the debt to GDP levels, but this is something we can worry about 3, 5 years, 10 years down the road. There's so much stimulus happening right now. It's kind of like, injecting someone who had a heart attack with like steroids, and when they come back, they recover from the heart attack, all of a sudden, you know, they're a totally different person. And so I wouldn't discount this in terms of how this can predict the future direction of the market. Just this amount of stimulus is happening, both from the central bank and from the government. And I think this is a net positive in the next 6 to 12 months for the market. What do you think of that?
Yeah, I would agree with you on that. And I think a lot of it goes back to where you're looking for, or where you're looking to buy stocks. And for instance, and I'll just do a plug here for your small cap service that you've launched recently. Small caps, I think, are a great place to look because unlike, you know, the multinational, you know, super large caps, many of which now basically have, you know, government stakeholders in them, small caps sold off very hard. Basically, you know, the fittest of them are surviving or will survive, and they're the ones that are going to have the least amount of debt. Again, unlike most of the large caps in the S&P that have huge amounts of debt that they're carrying around. Mm-hmm. So in that kind of environment, I can see where small caps will outperform. They're a great place to look. I think you're in exactly the right spot with your small cap service that people can subscribe to as another service.
You know, thanks, Jeff. Thanks for that shameless plug. One other thing about small caps is I view there could be, for the first time, believe it or not, inflation. Number one, because we're getting so much monetary stimulus. And number two, because the supply chains that we used to have are being shortened, where we're going to start producing more goods in the US and maybe moving a lot of production away from China. And so what happens in an inflationary environment, it's very good for small cap companies because they are, you know, they have more pricing power than the large caps do. And it's also good for emerging markets. And so who knows? I mean, we could see inflation for the first time in the last, who knows how long, 15 years or so, because of the fact that these supply chains are being cut and production is moving back onshore. But, you know, I want to just close talking about one other thing here, because I think this is important. And one thing I've kind of been watching out for is that I'll pull this chart. The market cap of the 5 largest companies as a share of the S&P 500 total is at 20. And that's the highest it's been since 2000. Now, when it was at 18% in 2000, we didn't have a recession shortly afterward, although the market did sell off, and then there was a recession about a year later. Does that concern you that investors are moving back into this market and they're, like you said, they're moving into these mega caps and nothing else? I mean, it seems like every time I look at the market, it's like Amazon is up again, Apple has moved up again, but then, you know, there's all these other stocks in the S&P 500 that haven't moved or have barely budged from their lows. And does that worry you as a longer term investor?
It does. You know, the line that keeps coming back to my mind is the line in Casablanca with the Claude Rains character. He says, round up the usual suspects. And every time we have a sell-off, that's what so many investors and the institutional and retail folks do. They all go in and round up the usual suspects of those companies you just named. Mm-hmm. And I do think that's a danger. Would be my bigger concern through the summer and the second half of the year, is that when we get to that level, presuming I'm right, and the market is going to be at or near all-time highs in the next 2 or 3 months, which I think is a possibility, then, you know, those stocks are going to be the most highly valued at a point where lots of people are pulling back on a lot of their discretionary purchases. So that does give one cause for concern. Doesn't mean that you should just run screaming from the stock market. It just means you got to be smart about what you buy, which I know you are, and I'd like to think that I am, generally speaking, in our newsletter. So I another shameless plug, but you know, I couldn't agree more that is something that people need to watch for, just because it's such an ingrained habit. Buy Apple, buy Netflix, buy Facebook is, I think, a better value, but it's the reflex. Amazon is like IBM in the 1970s and 1980s. You know, nobody ever got fired. That was the old saying. Nobody ever got fired buying or recommending IBM to their clients. And it's the same thing now. Nobody ever gets fired, you know, if they recommend buying Amazon, because that's the go-to pick.
Yeah. Also, it seems like Amazon is just eating all of retail right now without any retail stores open. I mean, I have with a new baby in the house, it feels like I've got multiple Amazon packages on my front doorstep every day. The other thing too, with these big cap stocks, it feels like that's where the new money goes to, because if you haven't invested before, you open up a Robinhood account and the first stocks that you buy aren't the kind of obscure stocks you've done your research on that you think could be higher. The ones you buy are the ones you know, right? You know Amazon, you know Apple, you know Microsoft, Tesla, and that's where the money seems to be heading right now with new money coming into the market.
That's so true. And the other final thought on this to me would be is the political equation, which is a big unknown, but depending on whether the Trump administration does another 4 years, if the Democrats come in, and depending on how big of a profile the progressive wing of the party has within the Democratic Party's policies, that could figure in mightily to what happens to a lot of these big tech companies, because they are so big, and you can see where the calls would be growing to break them up or break off pieces of them, which again injects uncertainty, which is the thing that Wall Street doesn't respond too well to.
Yeah, that was definitely a concern in the fall, but it seems like we have much bigger concerns about the economy right now than whether or not we pick up the tech companies. But Jeff, let's leave it there. I want to thank you for joining me again this week. Great to see you again for the first time.
Always a pleasure.
Several weeks. And thanks again, everyone, for joining us on this week's Market Insights webinar. Any questions, leave us a comment down below, or if you like our video, please hit the like button. And please subscribe to our channel. Ian King here from Smart Profits Daily. Have a great week. Stay healthy and be safe. Thank you.